So what we thought would be great is to have Ryno kind of just simply talk to you about what are the numbers that matter to you and what are the numbers that drive your business. So without further ado, Ryno.
Thank you. It's quite a good turnout for an accounting session at 3 o'clock in the afternoon. But a little bit about me. So I've been at Khosla. I've interacted, I think, with a lot of you. So been here almost 6 years now, operating partner. I do go to the investment committees. I do get involved in looking at the financials of investments when we make them. But I'm not an investing partner. I'm an operating partner. Before that, sold furniture for a living. Before that, which is probably the most relevant here, was CFO of a Sequoia NEA fidelity company called Zoom with an X, all the way from 30 people in a room with no revenue to IPO, ran it as a public company CFO for 3 years, and then we sold it to PayPal. And for better or worse, I am also an accountant. I am a Deloitte trained chartered accountant. A few simple ground rules for not only this talk, but also just for managing your business when it comes to finances. Remember, you're running the company here. You're not selling it. So be careful with momentum metrics like ARR, CAGRs, MRR. There's a time and place for some of those. But day to day when you're running your business, we're going to get to some other metrics that really do matter more. Be intellectually honest with yourself. That's obvious. David touched on this yesterday. Rather select the right metric, calculate it correctly, even if it doesn't look good. Know what it is. Have a plan over time to improve that and manage that versus trying to make a bad one look better by changing the definition. I know people are smiling, but I see this literally every week, where people change the definitions or they move stuff below the line, above the line, to make the number look better. And it's, you're fooling yourself, nobody else. There's just no real good reason to do that. Don't isolate any one metric. Nothing in isolation is necessarily good. It's all about trade-offs between all the different metrics, and we'll get into some inputs and outputs. Probably my favorite example is this that I used to do all the time for 3 years when Zoom was public. One of our key components of our COGS was transaction losses, online payment transaction losses. And it was also one of our key differentiators where we were better at transaction losses at scale, ACH risk, and chargeback risk. So we used to publish the number. It was 24 basis points or 25 basis points. And literally every single quarter, the analysts on the earnings call would say, well, it was 24 quarters. Can we do 23 next quarter? Or what should we model long term? What do we think it'd be? And I would turn around and say, no, I think we should lose more money. It's easy not to lose money, just turn away customers. I can make that number 10 basis points tomorrow if you ask me to. But there's a whole lot of consequences in doing that. So don't just focus on the one number. Be transparent with your team and your board on the numbers. I do go to a number of board meetings. I'm on a number of boards. Salesy board slides when it comes to numbers, there's just no benefit for anybody in that. Again, calculate the right number, show the right numbers, let's manage to the right numbers, and we can all work together to hopefully improve those. And then averages. This is not just for this talk, but across multiple. Be careful. Marginal CAC versus average CAC. There's a lot of examples like that. Just be careful with averages. The first one is define your unit economics. And I literally do this every time, and I must have done it over 200 times in the last 5 years at KV. I do this every single time I look at a financial or an investing deck or a financial model. Define your business in a simple equation of inputs and outputs. What matters? What key things really matter in this business? Because on the first one, the accounting P&L is an output. It's not an input. It drives me crazy when people say, what should my P&L look like to be able to raise the next round of funding? The much more important question is the one that I'm sure a lot of you have heard Samir or maybe Vinod say, what are the key milestones to raising the next round of funding? The milestones are important. How the P&L shakes out over the long term is really, it's a result. It's not an input. And once you've defined this equation, now the various parts of your business can understand where they fit into the picture. And this might sound straightforward and simple, but it's actually really important. I used to, every year, bring up the financial model and present it to the company and literally walk them through. It's like retention, that's you guys, customer service, product team. Like, size, transaction size per customer, that's you guys, product team. If you do this, move this, you can move the needle. Like, people know where they fit into the equation. One example, I'm going to go through a couple of examples. This is probably the most basic of the examples, but it's also the simple. So this is your typical direct-to-consumer business that Ryan would have touched on in the marketing one earlier. So you've got marketing divided by CAC is new customers plus your retained customers equals your active customers transacting in any given period times a revenue per customer number, your AOV, pick your number. It's revenue times the contribution margin. You've heard David talk about contribution a lot. I'll speak a bit about it. And that's your cash contribution. Now, in any direct-to-consumer business, this is it. Like, notice there's no R&D. Well, R&D is entirely controllable by you. Like, if this doesn't work, doesn't matter what R&D or G&A or some other items, your business doesn't work. Again, like David said yesterday, it doesn't mean this number has to be great to start with. You just have to define it correctly and then know how to manage these different inputs and outputs to get to a better outcome. So let me touch on a few of those. Marketing spend, go into as much detail as you can, like track organic, inorganic, by channel, as much as you can. Sometimes it's kind of false precision, but try and do as much of that as you can. It's all about the marginal CAC. Averages are so dangerous, And, and marginal CAC is not some fancy accounting formula. It's simply how much do I need to spend for the next incremental customer in this channel? Like, what do I think that number is? And it's not the average. Could be very close to the average, but it's not the average. Like, there's a curve. There's always a curve. CAC payback, I'm going to go into a simple Excel example on the next slide. When the cumulative cash contribution of a customer is the same as the CAC. So you go underwater with the CAC. Now the customer starts paying you back. When you've recovered that CAC, now you've got payback. Another one that's important is people, so, that's your payback period. Shorter is obviously usually better than longer, but it also really does matter what happens afterwards because we're not just in the business of getting our money back. There are different curves, and we'll see on the next slide on, you might have a 12-month cash payback, but then the customer, if they all leave at month 14, like, well, that's not good either because we have actually really created no incremental value. We've got our cash back. LTV, this is another favorite, to CAC ratio. Be realistic. The number of companies I see that's like a 1-year-old company, 2-year-old, they've got no data, and they say, well, our 10-year lifetime value of a customer is $500. I'm like, we don't even know if you're going to be around 5 years from now. You've got no data, and you're projecting out, non-risk adjusted, by the way, to 10 years. So it's not so much about, again, it's about optimizing and managing to a number against other variables. It's not so much about making the one number look as big as possible. There's no value in doing that. So it's the typical definition I like to use is a churn-adjusted contribution over the next 3 to 5 years. Just keep it simple. Like, don't do some kind of weird, people do end value, like, but it's annuity value right at the end, terminal value, and all sorts of weird things. If you don't have a good 3 to 5 year lifetime value, then you've got a problem. Like, there's really no business where that gets more interesting only once you go further out. In a direct-to-consumer business, you might have a different business. Cash contribution is simply defined as, and this is David's favorite, talks about this a lot. I'm also a big proponent of this. It's, if you think about let's say my restoration hardware example, my last business, it's revenue minus the product. We have product margin, which obviously the cost of the sofa, landed cost of the sofa. That was the gross profit minus the store costs was contribution margin. All the other variable costs to sell that furniture was contribution margin. In your case, it might be things like your Stripe fees or your customer service fees or your fulfillment expenses. If you sell twice as many goods, your Stripe fees are probably going to double. So it's a variable cost, so it should come out of contribution margin. A lot of people put it in G&A, and accountants might well be fine with you putting it in G&A, but it's not important. Like, that's not what we're trying to do here. We're trying to run the business here and make sure we optimize the right metrics. We're not trying to make the P&L look as pretty as possible. It's a very different thing to do. Be careful of ROAS. It's a metric I've seen pop up fairly often recently. By definition, it's a revenue metric. Like you could have a terrible business with an amazing ROAS. If you're just acquiring a whole bunch of bad quality customers, you'll have a great ROAS. If you're efficiently acquiring a whole lot of bad customers, you could still have a great ROAS, but basically have no business because they're all loss-making. Yeah, so this is how I like to do it. I know this looks very old school and non-technical and everything else, but it's just the simple math. You know, don't be afraid to model it out. So this example, you got a $75 CAC, average order size $50, a 40% contribution margin. And then, you know, there's the cohort curve, the retention curve. Literally, month 1, 100% transact, month 2, 60% transact. So the curve would look what you would expect it to look like. And then just model its cash flow. So month 1, you're underwater by $55 because obviously you pay the CAC, you get 20 back because 100% give you, 40%. And then you churn adjust that contribution as you go out, and there's your cash flow, and by month, it's about 12, you're cash flow positive. So that's the payback. You've got a 12-month cash payback, and I call it $86 24-month LTV year because, yes, there's still going to be some value here, but just for illustration purposes here, I'm obviously capping it there. So we've generated $86 in net return, in 12 months, which is in 24 months. This is not complicated. Like, this is, and most businesses, well, of these type, and there's obviously different capital-intensive businesses, and I'll get to 1 or 2 of those. This is like, just don't be afraid to model it out like this. Like, if you have, and this is a real example, like one of our companies, rented out equipment, but then they also had they had to go pick up the equipment at the end, and there was a real cost to that. So they left that out. So they said we have a 9-month CAC payback, but it actually ended up being something like 19 months, because they had this giant balloon expense 24 months out that they had to then go spend money to go pick it up again.
Marginal CAC, or is it?
Yes, no, that's marginal CAC. Yeah. Sorry, the question was, is it marginal CAC? Yes, it's the marginal CAC of that customer. And it's any given point in time. Now, what you can do then, once you've made this definition, made that, set up a spreadsheet, you can do like, again, this is super simple, but most people just don't think about it like this. So 12-month payback is good, but spending $75 to make 86, yeah, it's okay. It's not that exciting though. But so your initial reaction might be, hey, should we try and get the CAC down? Like to my earlier loss rates question. And the answer might well be no. Let's just get the product team to slightly move the retention curve up, and now we've added another $40 in value just by doing that. But it's hard to make these kind of trade-off decisions real time, all the time, if you don't have a framework for going back and saying, what is the value of doing that? What is the value of, if we lower prices, it's another great example. What happens? Well, your contribution margin goes out, your payback should go further out, your LTV should come down, but maybe not. Maybe retention goes way up, maybe CAC goes way down, and you can kind of play with these different scenarios. But be consistent with the model that you use to play with on those scenarios. This is the SaaS, RaaS, HaaS. Sorry, a lot of buzzwords, but it's SaaS, robotics as a service, or hardware as a service model. And the last two I should probably have bucketed together. They're the same thing. Same, very similar definition, but I think, again, it's important. Like, literally every business that I get involved with at Coastlow, where they ask me to look at the financials, I discipline myself to sit down and try and write that formula of what is really important in this business. Like, everything else is noise. You can control it. But what is really important in that formula? So here you have, again, CAC, sales and marketing CAC, but I split new customer and you have a new thing here as well called the amortization. So you have new customer ARR, existing customer ARR, then you have total ARR, but then there's this thing called amortization. And again, you have your revenue and your cash contribution. Sales and marketing, David mentioned this yesterday, include everything. Like, whether it's if you have a lot of travel expenses, I mean, you don't need to go silly, but like, don't try and be clever about, oh, what's in the number, what's out of the number, what's in the number, because again, who are you trying to make the number look better to? Just rather hold yourself accountable to the right number. If I've often seen the second point there done, where if there's two fairly significant groups, that's important for, like, maybe I'm aging myself, but in the days of, what was it, hunters and farmers, if there's two significantly different groups of getting new customers and expanding existing customers, split the teams, calculate it, different CAC on those different teams. It's easy to measure. You can put it in the same framework. Payback period's the same. I'm not a fan of the SaaS magic number. I think it was a good thing maybe 10 years ago. Because essentially, if you think about it, it only really applies to super high margin SaaS businesses. Because otherwise, you have the same problem as the ROAS problem, where it's a revenue metric, it's an ARR metric. You could have a great magic number by adding a whole lot of bad quality revenue, and you could still have a great magic number. If they're all 90% margin businesses, sure. But I think we're moving. But the cost of compute and some of these other things, I think we're moving past that stage where that's a reasonable assumption to just use the revenue number. Revenue recognition, amortize the contract. Just, again, common sense. Like, amortize the contract over the period the services are provided. Doesn't matter what the payment schedule is. If it's a 3-year contract or a 12-month contract, amortize the revenue over that period. 606, ASC 606, which is the US GAAP Rev Rec standard for the nerds. It might be it gets a little complicated in some, like, if you have complex contracts, that might get a lot more complicated. But leave that to the accountants. It's almost, when you're running your business, try and keep it simple. Like, even if you end up having 2 different revenue numbers, like, that's okay. Like, because I will get to my views on accounting in a few slides. It often doesn't make sense. It's often just not intuitive, and it's kind of busy work. When you're dealing with robotics and hardware, which is very different than the DTC example, make sure you include CapEx or a finance charge in your payback. And we'll get to that on the next page. But it's, if you're buying equipment to rent out to people or robotics, clearly you should provide for the cost of capital of that equipment in the calculation. That's one of your key inputs. Maintenance, depreciation. The estimated life is an interesting one. I've seen people trip up on this one too, where if people say, okay, this assembly line lasts at least 10, 15 years, I'm going to amortize it over 10, 15 years, and then I just pose a simple question, is it easy to rip and replace? Because you signed a 5-year contract, but the assembly line lasts 15 years. So the more conservative thing to do would be to amortize it over the 5 years of the contract, not the 15-year life of the equipment, unless it's easy enough to go pick it up and give it to another customer and redeploy it. So it's exactly the same spreadsheet, just a few more numbers on it, because now I've added debt funding, and I've added maintenance. So in this example, customer pays you $500 a month for this equipment that costs you $8,000, of which 75% is debt funded at 12%. You can see the impact of the leverage. It takes 2 months to install, and there's a 5% maintenance charge that costs for you maintaining this equipment, because the equipment's obviously yours. So there you can see, month 1, obviously, you've got to pay the $1,000 CAC to acquire this customer to start with. You've got $2,000 going out the door. That's your piece of the non-debt funded piece of the CapEx or the equipment. The amortization starts because the debt's paid for the other piece of the equipment, so the amortization starts. And what I've done here is that's just as simple like a mortgage. It's this 5-year amortize the debt over the 5 years of the equipment at 12%. You've got no revenue or no maintenance because it's not installed yet. And then month 2, there's just the debt. And then month 3, the revenue starts. And you just do the same, cumulative cash flow at the bottom. And in this case, the payback is, when you go positive, is 65 months. It's 14 months, 15 months. What's interesting is this is the exact same one. I didn't put all the numbers up here, obviously. But this is the exact same example with no debt. See how much longer the payback is. It's obvious, it's intuitive, because you're out of pocket, you're in the hole for much more early on because you're having to write the whole $8,000 check. So especially, and I'm going to speak about this a little bit later, but so companies that if you're lending off your own balance sheet, or you're investing a lot in working capital, or you're doing things like this, make sure you run the number like this, that you know the cost of that. There's a cost to that. Might be Vinode's money, but there's a real expensive cost of using Khosala's money to buy equipment to rent out. It's all about cash. David said that, mentioned that. Now, often, I ask the question there, is your balance sheet important? Often it's not. If you're a simple software business where you pay most of your bills monthly, your customers pay you monthly, the balance sheet probably doesn't matter at all. In fact, don't give us a balance sheet. And most companies, when they come present, don't do balance sheets. And that's okay if you're in that bucket. Everybody uses EBITDA these days. It's kind of funny. But it's okay if it's a good proxy for cash. And just test this assumption. Is it a good proxy for cash? Like, this is the obvious question to ask. If your business were to double in the next year, how much cash would you need? Excluding the operating expenses. Because then you'll know, is there some other dynamic going on, some working capital or CapEx or some other dynamic going on here? And if there is, then your balance sheet is very important. That's the point I'm trying to make up here. It's often not important, but when it matters a lot. And I'll get to a simple example of why that's the case. Let's talk about a few of the balance sheet items. Inventory, some of you have heard likes this. He speaks about inventory turn, the number of times a year you turn your inventory. I actually like the inverse of that. It's the same metric, but it's the inverse. It's how many days of inventory do you have on hand, which is literally that calculation there. It's your inventory divided by COGS times 365. And it's cash. I mean, I used to, not every day, but almost every day, we used to have this argument at RH about, it was all about customer service, lead time, making sure we don't run out of teak, making sure we don't run out of this color leather, versus you're tying up some real cash in these inventory balances. And all cash is equal. Like, whether it's burn or whether it's inventory, it's tied up. You got to find some more cash somewhere else then. So optimize that number. Think about things like lead time, ship times, how many days do you really need in inventory, which is why a lot of modern companies use what's called drop ship, where they never do the inventory. It just ships straight to the house. At scale, think about an ABL debt at scale. There's a lot of banks and other debt providers who do this. They will give you maybe not 100 cents on a dollar, but they'll give you 80 or 70 cents on a dollar to just fund your inventory. We've spoken about the RAS example, just reiterating again. This CapEx cost is real, so make sure you include it in your unit economics. And then I spoke about the reusable piece. Lending, I briefly mentioned this too. If you're lending off your own balance sheet, that's expensive. It's okay doing it to get some traction, and I'm not saying don't do it, but again, measure it. Make sure you know what those cash needs are. What does that do to your growth rate? What does it do to your runway, your funding cycles? Because it's still cash. Cash is cash. Working capital, this is one of my pet hates. When can you collect on your revenues, and when do you have to pay your suppliers? I've had a lot of AP people work for me in my life, accounts payable people work for me in my life, and they've all been super proud to come to you and say, I pay all my invoices on time. And I'm like, don't do that. Don't do that. Like, this is one of those numbers where negative is better. You're using other people's money to run your business. But step one is calculate it. Like, be sure to track it and calculate it and know what your net working capital situation is, that you don't get into the situation where as your business grows, your EBITDA might be looking okay, and I'll go into the example now, but you might need more cash. So this is a simple example I made up. Widget selling business that grew 100% year over year. Great business, grows 100% year over year. There's the P&L. It's generating, it lost 100, call it millions, we can do millions, 100 million in EBITDA. How much cash did they use last year? If I didn't show you this side of the screen, you'd probably say 100 million. But the actual answer could be 5 times as bad. It could be anything between 40 or 500. Depending on a few very basic questions, that's not even, these aren't aggressive. These are just very basic, simple questions like, how many days of inventory do they keep on hand? How quickly do they pay AP or have to pay AP, and how quickly do they get paid? And if you just make a few of these assumptions, like 30 days net or 60 days or inventory, yeah, they could have needed 500 million in cash this year versus the 100. That's a lot of extra cash to find. So if you're only looking at the P&L and you don't appreciate that your balance sheet really, really matters, you're going to run into this problem. Now, you might have the opposite. You might have a great situation where people, your customers sign 2-year deals and pay you up front. That's great. But you should present that and build that into your burn model and your cash needs because that's your business. I'm an accountant. I have a lot of accountant friends. I actually did audit and work as an accountant in 3 different countries, so not picking on accountants. But when running a business, GAAP accounting is just not important. It's not. Common sense and appropriate accruals matter a whole lot more. In fact, and I'll go into a few of my favorites, some of the stuff like software capitalization is actually dangerous. It's not just busy work, it's dangerous. So don't get bogged down with technical accounting. Focus on those formulas and the numbers that really matter in driving your business. Accounting is an output. Now, even when you're a public company, you're going to go out, you're going to hire an SEC reporting manager who's going to be a super technical accounting nerd. Then it becomes a little more important because you have to manage Wall Street and Wall Street's expectations, but you still don't let the tail wag the dog. Some of my favorites, stock-based compensation. It's just a complete waste of time. It's a complex set of assumptions that if you open any public company's financials, it's one of the longest footnotes in the financials. It's all based on one assumption on another assumption, and anybody who reads the financials just backs it straight up. So why do we just do all this busy work for? Well, if you're public, you have to. If you're private, you don't need to. When you run your business, just why are you doing it? Now, your option pool and dilution, well, that's important. Like how many people are you going to hire? What grants do you think you're going to give them? How much is available in the pool? Obviously, that's important. 409A, that's different. That's also silly. Don't get me started. Like that's where you have one expert arguing about another expert about each one making up a number that we all agree is wrong, but what is the wrong number to be wrong is really what 409A is. But it's an IRS requirement, so you don't get a choice. You've got to do that. Software capitalizations, I don't know if any of you have done this. Your accountants might have made you do this. This is basically where you reclass a part of your R&D expenses into a balance sheet, into property and equipment on the balance sheet, and then amortize it, supposedly over the useful life of that software. It's not a crazy concept for a public company financials, but again, it's the problem with the one assumption on top of another assumption on top of another bad assumption. And at the end of the day, if you go back to cash, you're still paying those engineers. So the worst that's happened, and I had a really pretty bad example of this come through our firm a couple of weeks ago, where they had no R&D on the P&L they presented to KV. No R&D. Tech company, no R&D. And when I poked, the accountant lady, who was quite reasonable, but she was outsourced accountant lady, quite reasonable, said, well, the accountants told me to capitalize it. So it was all on the balance sheet. They didn't show us the balance sheet. They only showed us the P&L, and they had no R&D on the P&L. And with a straight face, they said, we only need 8 or 10 million the next couple of years, but they left out the $18 million in R&D expense because it was all on the balance sheet. No. So just don't go there. I mentioned 606 earlier. It could get complicated. It's usually not. It's when you fulfilled your obligation under the contract, recognize the revenue. If it's a monthly, if it's an annual thing, if it's a 3-year thing, it's usually 90% of the time it's pretty straightforward. In the edge cases, it gets messy, but it's usually fine. Lease accounting. Sorry, I had to put it up. I don't know if any of you have even done this. Please don't. It's a new statement that came out 3-4 years ago where it basically turns every operating lease into a gross up of your balance sheet. It's like the right of asset and the right of use liability, and the two offset each other. And you basically, anybody at our age, overnight, we put $2 billion on either side of the balance sheet. $2 billion. Market cap's $4 billion. And what did the analysts do? The analysts said, I assume we should just cancel the two out and ignore it. I'm like, yes, that's exactly what you should do. And it was a 2.5-page footnote to the financials. Love accounting, but no. Let me go through, and then I'll open it up to a bunch of questions. But let me go through my favorite P&L and balance sheet layouts. It might look familiar because David's, I think, was the same, or P&L anyway. Gross margin and the contribution margin. I think that's a good discipline. We've covered a lot of what's in and what's out. It could be the same. If it's the same, that's okay. But at least go through the exercise of thinking, is it the same? Include CapEx and working capital at the bottom of your P&L if it's important to get to a free cash flow number. And that's on the next slide. Like I mentioned earlier, it might not be. It might not be, and your business might be really simple that burn and cash is almost the same thing. That's fine. But just make sure you've gone through that exercise and it actually is the same. This is another one of my pet hates. People lumping, you get to OPEX and it says staff and all other OPEX. I just don't, and I know a lot of you have done that because I've seen your financials. It's not an interesting, it's just not the right way to look at it because not all staff's equal. If you go back to the unit economic formula, like what are they working on? What are they impacting? Should we spend more on product to improve our margins, which will improve the LTV versus G&A spend and accountant? And they're all in the same bucket. It doesn't help. So at least put them out. These are my buckets that I like to see normally: sales and marketing, R&D, and G&A. But obviously, you could have other buckets that's important to you, or more or fewer buckets. But putting all people together in one bucket has never made any sense to me. A lot of people do it because it's the easiest way to do it, but it just doesn't make sense. And this is another one that's crept up a few times now recently. And again, I've seen hundreds of company financials come across, is when you show a cash balance, make sure it's cash you can actually use. If you've restricted some cash for some debt facility or some bond payment somewhere else, take it out or show it separately. But at least make sure, because people assume the cash balance they see they can use. So this will look familiar. The only new piece here at the bottom is you've got EBITDA, and then you've got the CapEx, the working capital adjustments, which is the net of that other calc, and then you've got your free cash flow. And then I actually do like to put the cash balance at the bottom, where it's like, this balance plus the free cash is the closing balance, so you know how much cash you have. The math is simple. It doesn't have to be tied perfectly to the balance sheet, but if it's close enough, it's great. These are also the columns I like, current quarter, year to date. I like to keep a rolling forecast. To me, history is history, but it's always interesting to see what do we think the year is going to, now that we know what Q1 looked like or Q2 looked like, what is our latest view of what we think the whole year could look like? Based on obviously the actuals we have to date. Balance sheet is simple. I like to put safes here. Some people put it in debt, but your safe notes are going to convert to equity, so I like to put them in equity. Debt, and then make sure you have, again, you can keep it simple. Like most people, the balance sheet is pretty simple. If you have a complex balance sheet, then it really, really matters, and you probably, then you have things like the loan book and stuff like that. We've seen too many lending businesses where people are lending off their balance sheet where they don't even give us a balance sheet. I'm like, guys, you're using your balance sheet to lend people money, so you have this giant receivable building on your balance sheet, but you're not even showing us the balance sheet. And finally, and then I'll take a lot of questions until the note shows up. How can I be helpful to you? If I can't, that's okay. That's fine. if you think I can be helpful, please reach out to me. These are just some of the things I play this roving consultant dude at Khosla. You know, I can give you feedback on your model. Sometimes people like a cold read on their finance slides in their deck, like, you know, treat me as the VC you're going to see tomorrow that doesn't know anything about your business. Just send me the deck, and I can poke at the numbers and say, well, if that's true, then this number, then that doesn't tie because this can't like be that. I do a lot of finance hiring, and I'm all about helping people think about their finance orgs. I've had some very big finance orgs. Skill sets matter, the titles don't. You know, people often call me up and say, oh, the board told me I need to go get a CFO. And I'm like, well, hang on. Like, what skill set do we need? Like, what are we missing in the organization? Maybe what you really need is a controller because you have a kick-ass strategic finance dude who can do that already. I have a lot of bank and audit contacts that I can introduce you to. Think about venture and other debt options. I mentioned a few on that earlier slide. Been CFO of 2 public companies, so yeah, if you want to know some of the fun, ask Bruce or me about the fun of running a public company. But I don't do technical accounting. I leave that to the accountants who enjoy doing it and are much better at it than me. But at the end of the day, remember, the model is yours. You're going to live it. You're going to breathe it. You're going to believe it. So come up with that formula. And you know, any questions? I know we're recording it, so we need the mic.
Hello. Hello.
Oh.
Thank you very much for the talk. Yeah, just a question here.
Yeah,
sorry. I just wanted to ask, what's the practical intuition behind the contribution margin? Because it seems to me LTV CAC and contribution margin are both sort of measures of profitability, but also quite different.
No, I think it's if you think about the logic behind unit economics is at scale, if your unit economics pan out, you should be able to just pour on the gas, and as you pour on the gas at the top, the contribution margin falls out the bottom. If you've got it nailed, like David said in his earlier slide, that's the logic behind it. You know, everything else, you can control OPEX, you can control G&L, but if you're at that point where you can say, okay, if I pour in another $1 million at the top, $100,000 is going to fall out the bottom. And if I make a few improvements here in the middle, $110,000 falls out the bottom, or $120,000 falls out at the bottom. That's why it's so important to look at the contribution margin if it's materially different than the gross margin. If they're the same, they're the same. But if you might have a great, like at RH example, like we had very high product margins. those couches are expensive, as you probably know. But the contribution margin was a lot lower because these fancy galleries are not cheap. You know? So you couldn't just say, okay, if we sell twice as many couches, we're going to throw off twice as much cash. Well, no, that's not true.
So is that because at scale you're expecting the variable costs to basically fall?
Yes, and you can build that into your model, the fact that the variable costs go down and your contribution margin gets better at scale. In fact, you should build that in, hopefully. But you can't assume that they become, unless it's really true, you shouldn't assume that they go away entirely. You know, that's why like payment processing, and I think I mentioned the Stripe fees on there, is one of my favorite ones, where a lot of companies, and obviously RH did it, by the way, payment processing was in G&A. But whenever I looked at the numbers, it's 2%. There was, in fact, RH's was actually 3% because a lot of Amex cards in the mix. For every single dollar, we sold, or $100 we sold, $3 went to the payment processors. That's real margin. The fact that it's in G&A doesn't matter. It's real margin, and I can't get rid of that. There's no way, even if I'm 100x bigger, I'm still paying that 3%. Maybe it's 2.9, but it's still a material number.
We've got just a few minutes.
Yeah. So, got a mic here. Question on appropriate accruals.
Yeah.
So possibly simplistic. Just want to make sure I understand what you mean by that.
Yeah.
Because obviously it could. I'm guessing. So, but from my standpoint, might be with a 6-month contract for contract research. Let's make sure we're accruing that over the period, not just having a big spike at one point.
Yes, that's exactly what I meant.
Okay, all
Yeah.
right. So it was also
Yeah,
like, is
no,
it the right
and
visibility for
that's
management accounting?
I meant that, but I also meant the example I used about maybe I mentioned one earlier, which was the company that had to go back and take the equipment out. There was real cost involved in setting out the trucks and uninstalling it. So that's coming. So you should start accruing for that expense, so that it's not just one big lump sum expense right at the end. Another favorite is provision for losses. If you're lending off your balance sheet, even though you don't have much data earlier on, you know it's not going to be zero. So you should, at least in your unit economics, on your balance sheet, in your P&L, start building up a provision for losses that you can obviously and should refine and get better at over time, but make appropriate accruals for these expenses you know are coming. You might not know exactly what they are yet, and they might be in the future, but you know they're coming. Okay, we'll take one more, and then I'm told we need to stop.
I have a question. Thank you very much. Right here.
Yeah.
Would you mind providing an example of how you would look at some of the industrial technology companies in the audience? Like, for example, our business, we build large factories that we sell product from. There's others here who make steel factories or cement factories where there is years of research and development and engineering scale up. And then you can start to look at financial models like this. And so it just seems a little bit different.
No, it is different. And it's not, it's different in the sense that what I typically do when I see those is I split it into whether you call it four-wall or project or factory level economics, and then the corporate economics. And at the corporate level, you have the R&D, you have obviously G&A, you have all that kind of run-up, which there's no revenue. That still, you're building this up, that's fine. That's fine. But then the one you really want to optimize, that formula you need to start formulating in your head, and that you want to optimize in the long run is, at the factory level, or RA's example, at the store level, the four-wall, or in your case, it might be a plant or one factory or multiple factories, because there's obviously a CapEx of building that out. What is the payback on that factory, on that CapEx? What is the life of the, so you can apply that same hardware as a service example I use at the factory level, and then you just add the corporate as a layer on top of it. That's where I would look at your unit economics. I would put it at that level, because that's what matters. All right, one more, and then we're going to kill it.
So, Ryno, I actually want to do a quick plug. I want to do a quick plug rather than a question. So we're founder of Adapt, we're an FP&A tool.
Yeah, there you go.
So many of you taking pictures at Ryno's favorite P&L. So if you need help instrumenting that, we connect to your ERP, to your CRM, different systems, and we help you build those. So either helping with our tool, or actually just pointing you at the right direction. If we're not the best fit, happy to help instrument what Ryno presented.
Great. Please do that. Thank you. Right. Nope, we're done. I'm told. Sorry. Vinod is next up. I cannot hold up Vinod.